Okay, cool, Kevin. Well, this is the last webinar for the tax, real estate tax strategies that how you put on. And today we'll be talking about short-term rentals. I'll just let you get going, Kevin.
Awesome. Thanks, Eric. Let's see here. Let me share my screen real quick. Screen two. All right. So we're going to dive into the details of the short-term rental strategy or strategies, um, turning short-term rentals into long-term wins. This is a pretty popular strategy the past couple of years with the COVID Airbnb blow up. But yeah, we'll just dive right into it. Already done this a couple times. Who am I? Um, I am a CPA. Also, kind of been in the real estate game since 2020 and, house hacker, remodeler, property manager. My wife and we manage a couple properties in and out of state. We have slash, I guess we still have all Airbnb, midterm rentals, and long-term rentals. So know the real estate space pretty well, not just from the tax side, but can talk shop, nuances and details as well. Who isn't this guy? I'm not a lawyer, hence I'm not your lawyer. I'm also not a CFP or CFA. I do not give financial advice. And all the tax information in this, as I mentioned, I am a CPA, but I'm not your CPA, probably. All information is meant to be educational. Topics for today. Okay, so shifting income loss slash loss status with STRs. Get into that. We've already touched on it a little bit in the prior presentations, but um, reiterating the importance of this, the 7-day rule of what that means for an STR and material participation. And then this is an important one. What I see sometimes that people don't consult with the CPA and try and implement this strategy, or don't come talk to me in the process of buying a house or thinking of going the STR out, is the personal usage of that STR is important, and tracking that is important. Last but not least, the stacking strategies. Again, we touched on this on the last presentations and went into details on cost segregation studies. But this is where you really maximize the immediate benefit of a cost segregation in year one when you combine it with an STR. All right, so shifting passive income to non-passive via STR, and you can say income slash losses up there. But as we already talked about, rental real estate is inherently passive under the internal revenue code, and thus any losses from it cannot offset active income. Think of your W-2 income, or if you have a trade or business, think of that business income. Generally speaking, active income and real estate income stay in their separate lanes. They generally cannot cross. There's a couple exceptions to that. One being the primary exceptions to the rules above are the active participation rule, real estate professional rule, and the short-term rental property rule. And I see some people are jumping on off, but if you have questions throughout the presentation, feel free to just ask them, at will, and unmute yourself. But um, so touching on all of these topics real quick, the idea of the tax benefit of shifting your rental real estate losses into the quote unquote out of the passive bucket is that if you have a loss, you can now decrease your W-2, your business income, and thus lower your overall taxes for that year, while hopefully in the real world generating cash flow. And how we do that is through one of these three exceptions to the rule, right? W-2 is active, rental real estate generally is passive. Do not cross unless you hit one of these three rules. The first one is the active participation rule. Essentially, you have to the active participation rule is it can be any kind of property, long-term, short-term, midterm, whatever. As long as you, and I mean, if an STR, it doesn't really matter at that point, but let's just go midterm, long term on the active participant rule. You have to self manage the property essentially, and your income has to be below 100 grand to get up to a $25,000 loss if you generate that much of a loss. Between 100 grand and 150 grand of W-2 income or business income, let's just use for simplicity here, there's a phase out of that $25,000 loss exception. Every $2 you're above 100,000, that $25,000 loss exception goes down by $1. So it's a 2-for-1 trade-off. Generally, I see this for, obviously people making, less than 100 or less than 150 grand. It's easy to implement. They have a long-term rental or a midterm rental. I ask them those questions of, hey, do you self-manage it? What's your income level? Okay, we probably have some wiggle room here to throw this active participation rule in there. The next one we also touched on is the real estate professional or reps status. The easiest example, and there's 11 industries that qualify. I won't go into all the details, but essentially you have to work full time as a real estate professional in one of those industries. And if you're a W-2 employee in one of those industries, you have to own at least 5% of the company that you're doing work for. The reason for that is to hit real estate professional status. There is a bunch of hurdles, and the two biggest ones are the hours hurdle, I'll just call it. You have to work at least 750 hours in the real estate professional world, and you cannot work more in any other industry. So this does not work for someone who's a software engineer full time and manages all their properties full time. They could have a bajillion properties. You will not qualify because the IRS is going to say it is effectively impossible for you to work a full-time job and to work your real estate job more than your full-time job. On the first slide, I kind of showed the math on this and why that is, but it's basically like you would have to work, I think it was 77 hours a week, every week for the whole year. And you have to prove that. So there's, I don't know, a single court case where someone has won that battle. The last one here is the STR, short-term rental properties, which we're going to dive into in some more detail here shortly. Short-term rental is the super exception to passive rental losses. It's one of the most powerful real estate strategies who are high income earners, make more than 100, 150 grand, going back to the active participant rule I mentioned, to offset their active income with real estate losses if they're not a real estate professional. You may be asking yourself, what qualifies as a short-term rental? The average period of customer use of the property is 7 days or less. And usually if you're on Airbnb or VRBO, it tracks that. Like you can pull this report down and you can see what the average stay is. The taxpayer, you must materially participate in that property. And we've kind of touched on what material participation is. I can't recall if we'll go into more detail on it, but just for high level, is you have to manage the property and no one can do more work than you on that property. So biggest caveat or biggest interrupter to this is cleaners. And it's not by a cleaner by cleaner business basis, it's business by business. So if you hire a cleaning company to do the cleanings on your STR, you have to track every time they come in and out how many hours they spend. And right, you don't have to be like so granular where you're watching them and timing it. It's, oh, we had 70 turnovers this year. They take about 2 hours. So they worked 140 hours on our property. Did we work at least 100 hours and more than them? That's one of the material participation hurdles. And if you could essentially say, yeah, they worked 140, but I have a log here that shows I worked 160, and you can combine that with your spouse. So we worked 160 on the property, whether it's lawn maintenance, snow shoveling, putting furniture together, answering tenants' messages, et cetera, et cetera. So you need to hit both of those for your property to qualify as a short-term rental in the eyes of the IRS. Okay, so I'm going to dive into details on 7 days or less. tracking your average stay by each separate rental property, right? It's not the aggregate of your properties, it's each separate one you have, you do this analysis for. Um, Again, most softwares will track this for you if you're just operating through one or two platforms. The IRS describes a period of use as defined as each period during which a customer has continuous or reoccurring right to use. All right, that's a misspelling. To use an item of property. So if they were there Monday through Wednesday, that's 3 days. Um, excuse me. If you try and get fancy with it and to have them book one day, 3 stays for one day each back to back to back, that won't work. If anyone ever looks at it, back to back leases or stays for the same individual are considered the same period of customer use. So don't try and get too creative with this. If you have a multifamily building with a mix of short and long-term uses, it gets a bit complicated. It gets a bit complicated because you have options here, and really it comes down to the administrative burden. Technically speaking, a lot of times you look at a property as a structure. So in a multifamily, right, let's say you have 10 units in one building, you would look at the average stay. If you have 6 long-term releases and 4 short-term Airbnbs, it's going to not be an STR. But if you wanted to, you can still break out the books by unit, which is probably more costly to do. But you would then have 10 rentals on your, and it'll increase the cost of your tax return, but then you're tracking it by rental property. And you can say unit A is a long term, unit E is a short term. And I can do, if I have separate books for that unit, I can take that loss if unit E is in a loss. I don't usually see that, to be honest with you, because it can get very complicated and increases again. Tax returns costs will go up exponentially. Your bookkeeping costs will probably be much more if they're not doing it by unit. The next hurdle is material participation. So I already kind of went through this, but yeah, essentially you have 7 tests you can meet. There's the 3 most common tests to meet material participation. If you have a property management company running your Airbnb, don't even try and qualify for this. It's just not going to happen because the IRS will slam that door shut because you're not doing a lot of the work. So the 3 most common are the individual participates in the activity for more than 500 hours during a year, period. So again, all of these you have to track your hours and sometimes other people's hours. The next one is the individual participation in the activity for the year constitutes substantially all of the participation in such activity of all individuals. So all individuals. If anyone else works on the property, in theory, you should track their hours. And the IRS doesn't necessarily define substantially all, but in some other court cases and other code sections, they say 70% is enough. I try and tell my clients get 80% to be safe. And again, that's just keeping an hour log in Excel somewhere. The last one and the most common one is the individual participates in the activity for more than 100 hours during the year, and no other individual participates more than them. Going back to the cleaning example, you have a cleaning company. Again, individual here is misleading. It's taxpayer company, or think of like an entity if you're engaging an entity to do the cleaning. You had 70 turnovers. They say it takes about 2 hours to do a turnover. They're at 140 hours. You and your spouse, if you're married, need to be over 140, right? Because if you're only at 100, the cleaning company just worked more than you. You do not meet material participation then. So that's an important key. Married individuals are able to combine their hours. That's an important fact pattern that can be missed. This analysis is done on a property by property basis. So if you have 6 Airbnbs, you need to track this and prove this out for all 6 of them if you want to safely take the STR benefit. And again, record keeping of the hours throughout the year is important. Let's see. Hours. So what even constitutes material participation and qualifies for hours? Hours that count is, think of it impacts the day-to-day operations or the layout, furniture, whatever of the property. Here's a good list. Preparing the property, assembling furniture is very common. Managing the books, communication with guests, collecting payments, coordinating contractors, walkthroughs, inspections. Hours that don't count, tax prep. Yeah, that I need to update this slide. This should be striked out. Well, actually, if you're managing the books and talking to a bookkeeper who's doing the books, that can drop down into communication and coordination with contractors. So doing the tax prep or the bookkeeping yourself wouldn't qualify. Education, so reading books, listening to podcasts wouldn't qualify. Going to seminars wouldn't qualify. Going through the process of purchasing the property would not qualify. Your hours do not start until you actually own the property and step in there with the keys. Paying the bills doesn't count, and traveling, it depends. If you're an easy one is if you're driving there to fix a toilet, those hours count. If you're driving there and you're going to be spending a day working on it and then another 2 days in the area with family or something, then you probably have to take a haircut on that travel. Material participation grouping. Again, like I mentioned, material participation is a test done on a property by property basis. So if you have multiples, you have to qualify for all of them in 1 year. The IRS, however, does provide a grouping election, whereas all properties can be treated as one economic unit. I'm not going to get into too much detail, but it's an election, and making this election could have a ripple down effect if and when you sell properties. So this election is not made lightly. I generally don't recommend it if if the only goal is for this year to hit like material participation on 3 of your locations, because it is a binding election. So always have a discussion with the CPA and think through the current and future plans for them. Personal versus business use. Why does it matter? So personal use of a rental property matters because it could limit the amount of deductions you can take against your rental income and potentially recategorize those from an STR to what the IRS calls a secondary or vacation home. The problem with this is when you have too much personal use of your STR, which we'll define shortly, it is now redefined as a vacation home. Under the vacation home rules, you cannot take a loss, period. So even if your property, after doing a cost seg, you in theory on paper generate a $50,000 loss, we take a haircut on all your expenses to bring that loss to zero, that profit and loss to zero. It is a bad place to be in. I've had a client or two come to me after the fact. They engaged me after the year ended and had to break the news to them that, hey, this is a vacation home by the definition and what you tell me is going on. So what is a vacation home and how do you stay away from it and the personal use rules? So there's 2 hurdles. There's 2 metrics to look at. One is if you use the property for personal use more than 14 days or 10% of the total time it is rented, then your home is classified as a vacation home. Generally speaking, I try and tell clients 14 days is your limit. And even then, you're still going to take a haircut on your expenses. So the less personal time, the better. But if you exceed that 14 days, you might be limiting your losses in that year. So what is defined as a personal use day? And this is where, again, tracking is important. If you're going to be using this nice, luxurious Airbnb up in the mountains, the beach, the lake, whatever, you need to track these days. A personal use day is a day in which you use the property for your own benefit. A strategy to get around this is when you are visiting the property, have some sort of projects lined up to be doing. Because under the regulations, if you go to your Airbnb and you spend at least 4 hours in a day working on the house, landscaping, swapping out a toilet. You have a list of things that you're going to do the week of Christmas, right? And you spend only 4 hours a day proving that out, going to Home Depot, picking up some parts, that kind of stuff. That entire day does not count towards personal use. So you wake up at 7, you do 4 hours of work, you go ski in the afternoon. That's not a personal use day. Um, so that's for you, the owner specifically. Other thing is direct family use the property for their own benefit. Even if they pay fair market value. Think parents, grandparents, kids, they use the property even if they pay you. That's a personal use day. Friends use the property for a discounted or reduced rate or for free. That's a personal use day. So tracking these is important, especially your time and your direct family. Strategy stacking. We kind of went through this on the last presentation, cost segregation studies and what they are, but combining I always say cost segregation is beneficial, whether the property is a midterm, long-term, or short-term. Because your worst case scenario, you have to get it done the first year the property is placed into service anyway. And even if it's not a short term, it's a long term, let's say, you're building this cachet of losses, assuming you're not expecting to sell the property in the next 2 or 3 years. So, yes, you have to pay for it up front, but you get it done. You're sitting on these losses, this huge benefit that you're going to take over the next couple of years. You don't just lose those losses, they carry forward. But in an STR situation, this is like the souped up, like how to take your losses against your W-2, because you're going to be generating a huge loss in the initial year via depreciation from the cost segregation study. And then you're actually able to use that loss to offset your W-2 if it's a short-term rental. Again, it allows for a taxpayer that isn't a rep real estate professional to take those losses to offset their W-2 income or their spouse's W-2 income. Timing your rental as an STR. Wow, my spelling was atrocious I don't know when I wrote this. In the first year is paramount to this strategy. So if you're a perfect example of this is buying an STR in December. If you're like, hey, this property pencils out as a midterm, long term, and short term, but to be honest, I hate running and managing short terms. Well, in theory, all you have to do is meet the 7-day test and the material participation for December. You run it as an Airbnb, you hit those things. Come January, you find a long-term tenant. You get the souped up losses in that tax year, that December tax year, the first tax year is placed in service. Then the second tax year, we just treat it as a long-term rental going forward. Oh yeah, I always forget to show this. So cost segregation, we kind of went over that. It's just divvying up the property into different components that you can depreciate faster. Believe that's it. So yeah, that was, I think a good culmination of the other presentations too. Kind of built on top of them, especially the last one. This was the last of the series, and kind of again, I thought it brought it all together and how to maximize the benefit with STRs. But there's my email up above. That QR code should take you to my website, and yeah, I'll toss it back to Eric to close us out here.
Yeah, awesome. Thank you, Kevin. That was super informative. It really helped kind of anchor in for me those rules and strategies, how to, like you said, stack it. And so thank you everyone for joining. We will have this recording, which I'll send it out to everyone, but we'll end here early. Everyone have a good night, and we'll talk soon. If you ever have any questions, please reach out to Kevin or myself. Bye.
Yeah, have a good one.